All right, welcome everybody. Hope you're having a good day. Who we have here? April, RG, Catherine. Kathy, I'm trying to see names that I recognize. Dennis, Mark. What's up, everybody? We've got a few of you on. Let's get started on this one. Hope you're having a good morning or afternoon, depending on where you're coming in from. I want to give you the latest update, but I just discovered this cool little thing and I want to share it with you. I don't know if you knew about it. Maybe you did. I'm going to share it on my screen and then share it to you in the chat. There's this little market clock from Realtor.com. It just uses their data. I put it into the chat, and it's a little behind, obviously, because we're in July, right? But at least it gives you some data going back about 2.5-ish, 3 months. Thought it was kind of cool because I was looking at hours and what we built. Here's what we're at. And the news right now, whether you go in the Wall Street Journal or you go to the New York Times or anywhere, Fox, CNN, it's the same thing. The war is affecting oil prices and those oil prices because, and let me explain this to you because it's not as clear to everyone, and that's okay. The oil situation in the United States, and obviously everywhere else too, but in the United States, every time prices go up, and if we go look at the bottom here for oil, because I just added crude oil. If we look at crude oil, it's up and down. It's heading up more so than down because of the war. Anytime you see the prices of crude oil going up, it creates a challenge for us in the housing world because it doesn't allow us to do as much because things need to get from one place to another. You know, all the material for the houses that are being built, well, they go on a truck. They go from one place to another. All of these little pieces matter. In fact, it's all connected to traveling. And so one thing needs to get to somewhere else. And so the cost goes up. And so that has then a direct connection to costs for other things. And so if you go to take a look at where our mortgage is, mortgage rates, 30-year fixed, this is tied to the mortgage. Well, what do we tie this? Mortgage News Daily. That's what we tied this to. But if we take a look at just the last year, it's gone up since the war. And we already know that housing is mortgage rate sensitive. Now, with the Fed meeting currently, right now, as we're speaking, we should have them come back and say, hey, we're probably not going to move the rate, the Fed rate. And it may go up, who knows, but it looks like it's not going to go up anywhere. If we compare the Fed rate to the 30-year mortgage, let's take a look at that and find the Fed rate. I keep on adding things to this, and now I have to go look for them because I knew where they were. But we're going to go, we're going to, you know what, we'll add the 10-year Treasury yield to it and then the federal funds rate, which is over here. We'll see all three of these just to compare. All right. Hmm. Let's go compare the last 5 years. And that's pretty damn close. Look at that. You've got the Fed rate pretty close. The Fed rate's the red one. 10-year treasuries, the green one. And then 30-year fixed, right, is the blue one. But look where what hasn't gone up. The Fed rate hasn't gone up, but you've seen mortgage rates go up. You've seen the 10-year treasury go up. Does that mean that the Fed rate then goes up? Because it typically kind of follows the same path, follow that red line, which is interesting to see, right? If we go 10 years, all of a sudden there was a disparity there, right? Boom, down. And you get to see it over 20 years and obviously 30 years. And look what happened during the 2007, 2008 debacle, right? Boom, it crashed. Hmm. But that needed to happen because during COVID, look what happened then, right? So you see what happens typically during those periods. Now we're not in that period, so we're going to have to see what happens. Let me exit the comparison because there are a few other things I wanted to talk to you about when it comes to where we're at and what's happening. Number one is that inflation, CPI inflation, is the main one. It looks like it's going up based on everything that we're seeing, and we don't know how AI is going to affect this world because we thought originally, and we meaning like the news, the media, we thought originally that AI was going to take everyone's job. We're like, oh no, AI is going to take everyone's. They're going to make robots. It's gonna be a bloodbath, and it hasn't happened like they imagined. Now they still need humans, and humans are still involved, but it's still creating some type of inflation. And on top of that, the United States government is still printing a ton of money. And because of that, it's causing inflation to go higher. And obviously, there are other things involved there, but this is only a 10-15 minute show. So, what I'd like to also show you is the shelter CPI, which then affects us more. If we take a look at the 1 year, just for us, things that matter to us for housing, it's gone up a bit, right? And that's important because that means we're going to continue to see if that trend holds, that the pricing for things that involve homes are going up. And so these are the things that I need you to be paying attention to. And when we look at the unemployment rate as well, it's tough. I've been trying to fix this one because it looks like it's good, but when you take a look at what's actually happening is there are a lot of people that would normally be in the job market that are just completely out. So they're not taking that into effect here. They're not looking at that and saying, hey, but overall, it doesn't look bad here, right? What I think is causing the big challenges is the war. When that eases out, we should start seeing the mortgage rates drop and then this confidence coming back up because at the beginning of this year, it started to look good if we look at where real estate was. And here's the thing that's allowing us not to crash. And let me find that because rates are going up, but existing home sales right here, existing home sales are still in comparison, let's go to 30 years, incredibly, in fact, astronomically low. Look at that. Year over year, it's just been flat going back to 2010 to see this. Even take a look at just the last 5 years through COVID, just the beginning of COVID, but down. There's just not enough inventory. So where a price is going, and even then, there are, if I could break this down, there are certain areas like in Florida, because we've got agents in Florida, and we're trying to open up Texas, so I can't tell you Texas too well, but Florida, we're looking at homes sitting on the market a lot longer. We've got a team out in Tampa, we've got Miami, Orlando, and it's not looking good. And agents, people are panicking. And we need to take into consideration those areas as well. So it's a tale of three markets. It's a market that now is extending days on market because things aren't selling. So the price correction is happening there and it's real. Then there's a market like ours, most of LA County, most of Ventura County. I'm right in the middle. It's pretty even. If it's priced well, it'll sell. If it's priced a little bit over, it's going to take a little bit, right? And obviously, if it's priced slightly under, it will sell pretty fast. So that's an average market. And then there are markets where things are still selling really fast in under 2 weeks. Not as many markets as before. So that's really the update. I want you to keep an eye on what the Fed says because the Fed's going to come back. Let me share one. Let me share this with you. This is the Fed rate, so we can take a look. Uh, if I can find my little card that I made with the Fed numbers, where is it? There it is. That's what we're looking at last 5 years. Obviously, the rate started going up and up to control inflation. The concern is inflation now. do they need to figure out how to control it, or can they kind of just keep it where it's at based on everything they're seeing? And remember, Warsh was just placed into this position, and he was really hot and saying, we've got to lower rates, we've got to lower rates. But now he's in this position and he's saying, wait a second, I don't know that we can lower rates based on everything I see, which is what we were saying last year. Anyway, that's all I got for you, everybody. Hope you're having an awesome day. Any questions, comments, concerns, clarity? Let me know. I built that whole thing out. That was a question that we got. I built this whole thing out on AI, and it touches on all of these different sources and updates them daily, right? NAR, MBA, government sites, the Census Bureau, Redfin, Realtor.com, everything, just so that we have a better picture of what's actually happening along with the housing market stocks, just so you can see how those are performing as well. All right, let me stop that. Have an awesome day, everybody. Thanks for tuning in. I will see you next week. Jim Black is on vacation, so he'll join us next week. Have an awesome day, everybody.